Next speaker is Dana Scheider. So, Dana Scheider is a senior software engineer at Cash App, hailing from Portland, Oregon. He currently lives in Melbourne, Australia. Since 2016, Dana has been one of the core maintainers of Cucumber. He is particularly interested in testing and quality management, diversity and inclusion, and improving processes within engineering organizations. So this talk is titled, In the Long Run, We're All Dead, An Economist's Guide to Tech Debt. Please give Dana a warm welcome.
Hello, PyCon. My name is Dana Scheider. My pronouns are they and he, and I'm so excited to see all of you here for my new talk, In the Long Run, We're All Dead, An Economist's Guide to Tech Debt. This is a pretty strong showing for right before lunch, so thank you all for coming. Currently, I'm a senior engineer at Cash App, but way back in 2010, I graduated from Portland State University with a degree in finance and extensive coursework in economics. So in that way, you could say that this talk is the synthesis of my life's work, other than the opera singing, but I digress. This talk will be a post-Keynesian analysis of macroeconomic forces driving adoption and impact of technical debt in the framework of the Minsky instability hypothesis. You got that, right? Don't worry, it's not on the test, but regardless, hopefully it'll start to make sense over the next 20 minutes or so. Basically, I'll be looking at technical debt in the context of the economic systems in which we all live and work. See, when the topic of tech debt comes up, I see the blame game a lot. Is it developers or managers who are incompetent? Whose fault is this phenomenon? However, in this talk, I argue that excessive tech debt is not brought on by incompetence on the part of developers or managers, but by macroeconomic factors not controlled by developers or management. I'm going to make the case that organizations take on technical debt, like other forms of debt, because they are structurally forced to. Bear with me. Before I go any further, I'd like to define some of the key concepts I'll be talking about in this talk. There's going to be a lot of information, and I hope you're able to stay with me here. But a few terms here. Market participant. I'll also be using the terms economic actor and unit. And a market participant is just someone who participates in a market in any way. So someone who's buying something, someone who's selling something, an organization, an individual, all of these can be market participants, and that's deliberately vague. Risk aversion is another important concept here, and that's the propensity of a given market participant to avoid risk. So a risk-averse entity is going to take on as little risk as possible, while a less risk-averse one might take on more risk. Finally, the business cycle. You may have heard this referred to as the boom-bust cycle, and the boom-bust cycle, think dot-com boom, dot-com bust, the ups and downs of the economy. And finally, the star of the show, technical debt. Which I define as outdated, unmaintained, untested, and/or, and let's be real, it's undocumented code or systems that often come from a strict prioritization of shipping features. So when we try to deliver things too fast, that's when we cut corners on things. Okay, so let's talk for a second about traditional economics. I'd like you to close your eyes, and if you took an economics class in school or uni, go back to that class. And you may remember learning that the invisible hand of the free market guides the market to a point of equilibrium in the long run. And these are true in some circumstances. The fact is there's a lot of fine print. These are true in microeconomic situations, first of all. They're true in situations of perfect competition. They're true in cases where all market participants have equal power. And so you can see how those things wouldn't necessarily be the case in the macroeconomy. And it's also built on the assumption that market participants are rational, which I would argue they're not. So for more complex situations, other rules apply. Enter English economist John Maynard Keynes. Keynes lived during the Great Depression, which began in 1929 and lasted about 10 years. Now, if markets love equilibrium so much, explain what happened in October of 1929. Explain that crash. And that's exactly what Keynes undertook to do. He found that in the long run, does a lot of heavy lifting when there's suffering to be mitigated now. The soaring profits of the roaring 20s didn't do much for the depression-ravaged 30s. Keynes believed that it was necessary for governments to take action in the immediate term to temper the business cycle, even at the cost of lesser prosperity during booms. After all, as he pointed out, in the long run, we're all dead. In order to explain what Keynes' ideas have to do with tech debt, I want to introduce the concept of leverage. There are two recognized types of leverage: financial leverage and operating leverage. I'm proposing a third type in addition: technical leverage. These three types of leverage seem quite different, but there are some common elements between them that I'll talk about on the next slide. So financial leverage. If you've learned about business at all, you may know that businesses generate revenues and profits with assets. If you don't have any assets, then your ability to generate revenues is going to be extremely limited. Those assets can be purchased either using equity, which is investment from the owners of the company, or with debt. That's financial leverage, the proportion of your assets that are financed with debt. Operating leverage is the level of investment in illiquid capital assets, so assets that can't be sold for cash without taking a significant loss in value. This is stuff like machinery, facilities, factories, that kind of thing. And technical leverage, I'm defining as the extent to which an organization prioritizes adding features over maintaining, testing, and documenting their systems. So what do these three forms of leverage have in common? Well, all forms of leverage represent risk to the economic actors that take them on. Now, why does this happen? Well, you may have heard the saying, no risk, no reward. And in this saying, we're talking about what we call upside risk. Taking risks can result in higher gains. You know, this might be the one that you strike it rich on. So the catch is that risk works kind of like a pendulum. It's not quite that simple, but we can visualize it that way. And when a pendulum swings hard to one side, it's going to swing hard to the other side. And that's how risk works, and that's fundamentally how Keynes' model of the economy works. Now, it's that upside risk that drives companies to adopt all forms of leverage and all forms of risk. However, I want to emphasize that it's not necessarily bad to take on risk. In fact, for a given entity, it's often possible to calculate roughly an optimal amount of risk that that entity should take to reach its profit targets or to achieve whatever it's trying to achieve. So that's leverage. Now, at the beginning of this talk, I said I would argue that organizations adopt tech debt because they're structurally forced to. I'm a big believer that extraordinary claims require extraordinary evidence, so to help you understand how this works, I want to introduce the Minsky instability hypothesis, published in a white paper by post-Keynesian economist Hyman Minsky in 1992. First, I'll explain Minsky's theory as he proposed it, pertaining mainly to financial leverage. Then I'll talk about how it applies to technology. So, Minsky divided economic actors into three different categories: hedge units, speculative units, and Ponzi units. A hedge unit is defined as an actor who can service their debt obligations using only their own cash flows. So these are organizations that are financially healthy, that have enough revenue and enough profits to cover any debt that they take on. Now, they may not do that. they may choose to take on more debt instead. But the defining characteristic is that they do have the ability to pay down all their debt with their own cash flows. A speculative unit is treading water. It can service its interest payments with its own cash flows, but if principal comes due, then those organizations have to take on more debt to cover the principal on their last debt. Finally, a Ponzi unit, named after the famous Ponzi scheme, is an organization, or individual for that matter, that's unable to service debt obligations with their own cash flows. And these entities, in the case of financial leverage, have to resort to selling assets. Now, like I said, you need assets to earn revenue and to make profits, so this is extremely problematic, and a Ponzi unit is a highly distressed organization that is likely to not be around for long. In periods of economic prosperity, hedge units predominate. So most organizations are financially healthy, and they also see a lot of gains from taking on upside risk. Market prices and conditions then adjust to reflect the behavior of the most risk-taking participants. So there are a couple examples of this, but you can think of it as the mortgage crisis, for example, that in the beginning, companies started investing in these mortgage-based derivatives, so bundled up mortgages, bundled up subprime mortgages, and at first companies got profits from that. At first they did well, and then things changed a little bit. So this is where we say that as market conditions change, all market participants are structurally forced to adopt the risk profile of the least risk-averse market participants. Now, by structurally forced, I mean that their continued ability to participate in the market depends on taking additional risk. To opt out of that risk is to opt out of that market. But what happens next? Well, over time, demand begins to level off. You can't grow, this can be mathematically shown, you can't grow at a higher rate than the population. Eventually you'll get to a point where the market is saturated, everyone who needs your product has it, and the only way you can get more customers is by more being born. Cash flow in this case is not as easy to come by, and returns on risk get lower because your growth is simply limited at this point, regardless of how much risk you take on. So speculative units begin to come out as some hedge units take on more debt to where they're not able to service that principal anymore. And the cycle continues because speculative units are still under pressure to take on more risk. And eventually, they are unable to service principal payments, or sorry, they're unable to service any of their debt payments and become Ponzi units. So mass failure of Ponzi units destabilizes the macroeconomy. So like those banks I was talking about, when those mortgages went bad, it crashed the economy worldwide. So how does technical leverage fit into this? Technical leverage represents risk as well. When you have a lot of tech debt, you will have systems that are difficult to reason about. Inadequate test coverage means that the bugs that are introduced because of this may not be caught quickly or at all. There's a lack of documentation that makes it really hard for new people to learn about the code base, and the result can be that knowledge gets siloed into one or two individuals. One sign that this is happening, especially in a small company, is when one engineer is hailed as a genius who's above everyone else. That person is usually the knowledge silo. So why do organizations take on tech debt? Well, some level of tech debt, like other kinds of leverage, can be healthy. It can enable you to deliver features. And so it's not about eliminating tech debt, it's about finding that balance. There are other reasons that aren't so good, though. VCs and other investors, the cleaning up tech debt is not visible to them. So they don't understand the value of it. In the meantime, as the company takes on more and more tech debt, and this is working in the beginning, and that risk is going up, but so are profits, the investors are like, this is great, let's do more of this, why not? But it doesn't work like that. It's not reasonable to make the assumption that market trends will continue on the same trajectory forever. What worked in the past might not work in the future. So I want to talk about Minsky's instability hypothesis as it applies to technical leverage. How do you translate these types of economic actors as it pertains to tech? So I define a hedge unit as a participant, an organization that has the staff and resources to clean up its existing tech debt. Again, it may or may not do that, but it's able to. A speculative unit is one that treads water. It's able to maintain its tech debt, but not reduce it. That could mean that it shuffles it around. It cleans up some, adding other elsewhere, but it's ultimately staying at the same amount. Now, these speculative units, again, as they take on more tech debt, if that's what they choose to do, they get into this ever-increasing cycle, and eventually they don't have the staff or resources to even tread water. Adding features takes too long, there are too many fires to put out, and tech debt increases. Eventually these organizations can fail because of the lack of flexibility that comes with having that much tech debt. And the impact on the economy can vary. It can be negligible if it's a small organization that maybe doesn't employ that many people or doesn't make a product that's critically important. On the other hand, if it's a large organization that employs a lot of people, these kind of failures can have a large impact, especially if there are multiple failures going on at a time, if many businesses are going through the same thing. Now, the thing I want to emphasize is that organizations know that they're getting into this. So organizations that are taking on tech debt in this way, they may know that taking that risk will not benefit them, but you can't win a game you're not playing, and they're between a rock and a hard place. So they take on that tech debt to attempt to stay in the game. So to summarize, there are a lot of benefits to taking risks during periods of economic prosperity, but you never know when those periods will end. And so as organizations gain an advantage and competitors are forced to take on more tech debt to keep up, not all organizations can sustain that level of risk, and mass failure of any kind of industry can have a significant impact on the macroeconomy. So what's the solution? Well, unfortunately, there's a reason they call it the dismal science. As you may have surmised, individual market participants, whether individuals or organizations, have a limited ability to change things. One thing that will be really useful is bridging the communications gap with investors, developing the skills to explain engineering concepts in terms that investors can understand, and to help them understand that tempering short-term gains is necessary if you want to create sustainable growth. Finally, worker solidarity. We're professionals here, and sticking together to insist on the integrity of our profession is something that we should be doing in this and a lot of other cases. No, the business can't just tell us to do anything and we'll do it. As a professional, I take pride in my work. I'm not going to do that. And if we stand together on that, then that can change some of the worst tendencies of our organizations. So, how did that happen? Oh, the conclusion went away. Oh, sorry, I got lost. All right, so we need to focus on standing together as professionals to insist on the quality of our work, and the type of systems we'd like to work on in the here and now. Thank you.
Thank you very much, Dana, for that information. I'll be sure to leverage it in future. Now, we do have time for a few questions. So if you are in the audience and would like us to send you a microphone so you can say your question, please raise your hand. And if you are in the audience or not in the audience or in the online audience and would like to ask a question, please post it in the Discord and I'll read it out on your behalf. We have our first question.
Thanks. How do you imagine the failure looking like? Because tech debt isn't like monetary debt. You're not going to get a margin call on tech debt. So what does failure look like, and have we seen it before in this context?
Well, you could argue that technical debt is actually a form of operating leverage. That would, and so meaning that that you're investing in a system that does a particular thing, and that may not be what you need to do in the future. You may need to either extend it, or you may need to pivot and change directions. And organizations that have excessive tech debt, and I've worked at organizations like this, are at high risk if they don't have the flexibility to respond to market conditions. So what it would look like is, it would look much like the failure of an organization that had invested in assets that didn't end up being useful for its business purpose. So it's not quite as obvious. It's not quite as, it's not published in an annual report like, operating leverage would be if you knew where to look. But yeah, it looks like the organization just kind of getting less and less flexible and less able to respond to customer needs.
All right, we have a question from the Discord, and while I'm reading this out, we have the next question from over here. Are there any moves on economic media to cover tech debt when talking about companies?
To tell you the truth, this is the first time I've ever seen any of this tied together, and I kind of developed this talk as I was working at my last company, which was a startup, and thinking about the tech debt that we took on. Sorry, could you repeat the question? I didn't remember where I was going with that.
Sure. Are there any moves on economic media to cover tech debt when talking about companies?
Okay. No, so as far as I know, I haven't really seen any kind of coverage of that or any kind of analysis of that, because economists aren't particularly technical a lot of the time. So there's not a lot of crossover, I think.
All right, question over here.
Hello. Harking back to Rudd bucks and government stimulus, is there an equivalent in your analogy of technical debt? When technical debt gets out of hand, is there an equivalent kind of government stimulus mechanism?
Yeah, I think so, because a stimulus measure like that would function to furnish these organizations with the resources that they need to hire staff and devote funds to cleaning up their tech debt. So that is how that would kind of apply to this situation. Does that answer your question?
I put this in the Discord, but I'll just ask it now anyway. Following on from the other question about talking about tech debt, how does one go around quantifying it? Because if you can't measure it, if you can't track it.
That's a great question. And it is a huge challenge. And to tell you the truth, it's not something I had extensively looked into for this talk. But you're absolutely right. It's a challenge. And I think the first thing is to do an audit to categorize the areas in which you have tech debt. Because like I said, it can be unmaintained, undocumented, untested code. So in which of those areas do you have deficiencies? Probably more than one. And then identifying where those deficiencies are. I actually have another talk that's about maintaining documentation that has that goes into how to take care of that aspect of it, but you're right, it's a challenge.
All right, question over here.
Thanks very much for your presentation. It was pretty interesting. I was curious, you mentioned that you've had this experience with startups. When do you think a startup should worry about tech debt? And I remember that famous quote about this founder of LinkedIn that said that if you're not embarrassed by your first product, you launch too late. I guess I translate that if you don't launch your product with a lot of tech debt, you launch too late. So when do you think is the ideal time for a startup to really worry about this tech debt? Otherwise, you could be just running on the risk of just launching something that has no tech debt, but the market is not really interested in it.
And that's exactly why I say that it's possible to have a healthy amount of tech debt. You don't need to reduce it to none. So a lot of times, that may mean that a startup is inherently a higher risk enterprise. And so startups will have to take on more risk because they're starting from nothing. So that's a good point, and it's accurate that's just going to be the case with a startup.
All right, question from here.
Is there a link kind of between hyper-specialization and tech debt? Because it feels to me one of the issues with this tech debt is that it's hard to kind of capture a new audience or to move on with the market. Does kind of hyper-specializing and working in a very specific niche audience kind of contribute more to this? Is there a link or?
I'm not totally sure I fully understand the question, but let me take a stab at it. I think one way that hyper-specialization does impact tech debt is that most people at some point have to work outside their area of specialization. And we all have to do things that we're not as good at. And so that can lead to tech debt. I'm a Ruby developer primarily, and I see a lot of bad Ruby that's written by people who aren't really Ruby developers. And so it can definitely contribute to the problem, but I feel like robust code reviews and mentorship can be really helpful to reduce that.
Thanks.
All right, I have a question of my own.
Yeah.
You talked about worker solidarity. Do you see that as being more of a role for formal industry-wide organizations such as unions, or as sort of more of the informal individual workplace, a small group talking to their own manager?
I think both. And one thing that I think about a lot is that a lot of technical organizations. Oh, I'm losing my train of thought again. I'm sorry. Sorry.
Oh yeah, just the role of formal organizations such as unions versus informal networks.
Yeah, and so one thing I've thought about a lot, I took some classes in mechanical engineering, and it was fascinating to me that the entire first semester of classes about mechanical engineering were devoted to engineering disasters brought on by unethical behavior on the part of engineers. Other fields of engineering have professional bodies that hold engineers accountable for the results of their actions, even if those results aren't intended. And I think that that's actually sorely needed in software engineering. That it would be good to have a professional body, so that we don't have to put ourselves on the line and go to our managers and be like, I personally will not do this. It would be helpful to have a professional body that will say, this is not what software engineers do.
All right. Thank you very much, Dana. We have the traditional speaker's gift and a round of applause.
Thank you.